Hello, everybody, and welcome to the Dash Trader Newsroom. Trump tariff showdown and earnings season update. Let's jump right in. My name is Michael DeJoyer. I'm the Director of Educational Services here at Dash Trader, joined by my co-host, Jill Molandrino, Global Markets Reporter at Nasdaq. Jill, how are you today?
Doing well. Thanks so much. Good to see you.
Fantastic. Let's jump right in. I mean, last week we had a crazy Monday as the markets gapped down big on the impending tariffs that lasted all of an afternoon, as it seems like the threat has been abated for at least 1 month, as kind of deals have been worked out with Mexico and with Canada. Yes, some tariffs were put on China. So Trump tariffs seem to be a Trump negotiating tactic. And so far, the markets have kind of factored that in. So what are your thoughts overall about the long-term impact of these tariffs? Are we going to see this kind of like the interest rate story where it gets kicked down the road month after month as different deals get negotiated? What is your thoughts on these tariffs from a longer-term market perspective?
Well, I think, Mike, from the corporate perspective, you're not going to see management teams shift around their manufacturing supply chain long-term strategies just because of a headline, right? So one, it's not just a light switch that you flip on and you change your entire strategy. It just doesn't work that way. GM CEO came on Tuesday, or it was either Monday or Tuesday, and expressed the same sentiment. We saw how quickly things can change, from Monday morning to Monday afternoon. The reversal with tariffs on Mexico. So things are moving quick. And anyone who is in the position of the C-suite or senior leadership is certainly going to have, the training and the understanding to be able to separate the noise from longer term strategic, modifications of their plans, right? So I think we need to recognize that. Now, the market is different than the economy. The market is different than corporate strategic planning, and it is going to interpret headlines as it sees fit and try and, be a forward-looking mechanism in terms of how it thinks the stocks will perform. But I would like to think that, all of these scenarios have, went through the risk management scenarios. It's not like Trump. This is anything new. We kind of went through these tactics in Trump 1.0. Granted, things are happening much quicker this time around, but I think it's pretty clear it's a negotiating tactic. And, I don't want to say who knows, or we'll see, because those terms are so overused, but it could be a new way of doing business and how they think about longer term with onshoring and, switching strategic supply chain locations.
Yeah, absolutely. It seems like it's kind of there's a threat of a tariff, and then there is a pause for negotiation, and then obviously they come back and things change, and then it's like a give and take, typical negotiating that we've seen with President Trump in the past. Now let's take a look at earnings. Obviously this may have some impact on earnings going forward in 2025. But thus far, the 2024 earnings have been coming in pretty much strong. I mean, there has been a few dark spots. Certainly, Alphabet, and AMD, could have done a little bit better than expectations. They actually did worse than expectations. What do you see for the rest of the earnings season? As we come in, we got the big one. Nvidia is coming up. We had all that news with China's DeepSeek AI. Me personally, I kind of feel I'm a little bullish on NVIDIA this quarter because I believe that nothing that DeepSeek could have done would have impacted NVIDIA yet, and it's still the industry leader. So I'd just love to hear your thoughts about earnings season and specifically the chip sector and
Right.
the AI space.
So I think with earnings, we have to remember, and we spoke about this on our last call, Mike, that we're reporting Q4 earnings, and this is forward guidance for the first quarter, looking out all the way through the end of the year. And it's similar to what you see in the futures market. It's going to be more expensive on the back end because there's more uncertainty. Getting insight into what full year will look like is more difficult in Q1 and forecasting and planning than it is later in the year. I also think we have to take into account, because there are a lot of questions around execution of federal policy and what tariffs may look like, putting forth numbers from an operational perspective could also add another challenge depending on your industry, your exposure to the dollar, like small cap companies as an example, what your balance sheet looks like if we're in a higher interest rate environment for longer. So making these forward projections in January and February is a lot different than we have more insight into the end of the year. And that's not specific to Trump or 2025. That's how it typically is with the earnings cycle. So I think that's important to keep in mind. As far as what happened with DeepSeek, I personally thought that the reaction was overdone. I think consensus is somewhat aligned there. I think the potential impact on the industry was a bit exaggerated because while that technology is innovated, I'm not quite sure how disruptive it'll be to the market, as drastically as the initial stock drops may have suggested. I think there's a couple things here. One, to think that NVIDIA and other competitors in the chip space did not think of these scenarios or have any insight into what's happening in the competitive landscape would be completely naive. So I'm sure they have thought this through on some level. I also think when you're thinking longer term as well, there is this expectation that as this technology becomes more ubiquitous and is available at scale, that companies do expect that competition will increase and that their pricing models and so forth, or their ability to remain as competitive as they may have been in the outset, there is going to be some shift there. I think when you're looking at these technologies that are leveraging AI and what's next with the chips and so forth, I think it's going to come back to hardware, where you're going to see that pendulum shift where it's not so much about the software, but you're going to need the hardware to really execute the demand that's required. So it's not as if that's all that NVIDIA is going to do, or it's all that AMD is going to do. To think that they are not more forward-looking than that seems unreasonable. So I think it was overdone, and I think that you're going to see the pendulum come back to focusing on hardware a bit. I think you're going to see this mad rush to cloud. You're going to see more hybrid environments as the cyber professionals of the company are thinking about, okay, perhaps we need to not be one or the other. We need some on-prem, we need some cloud, we need to have hybrid environments so that we can pivot and have alternatives and redundancies. So I don't think it's going to be an all or none solution, as much as the market may have initially reacted.
Absolutely. I feel the same way. It seemed to be a little bit of a knee-jerk reaction, and of course we see Nvidia bouncing back already, and I believe it was Bank of America came out, or it was Morgan Stanley that came out and said that it was one of their top picks going into earnings. So we also have seen that the banks had filed a lawsuit on stress testing, and now we see the Federal Reserve amending or streamlining their stress tests, and the banks were all up today, on this kind of streamlined stress test, which is basically an AI computer simulation of potential bank failures. So, what are your thoughts on the streamlined stress test and the state of banking currently, in finance?
Well, I think, and I did take a look at some of, I did take a look at the litigation that was submitted, and then also at the American Bankers Association to see what they were saying. And I'm not surprised to see that this is happening in what is expected to be a more business-friendly environment. And the banks do recognize that, stress tests, they're an important risk management tool. ABA, as an example, has advocated for the Federal Reserve to increase transparency when it comes to stress test program. And I think part of the issues are it's very opaque in nature, and the test undermines the value for providing meaningful insights into bank resilience. So and this is a common theme that we hear, is transparency, and for them to be able to develop supervisory models and stress scenarios, the Fed doesn't publish that. So it's almost like you're operating in a regulatory vacuum, because in order for the banks to meet their requirements as per federal law, you think it would be helpful for the Fed to provide supervisory models or stress tests or invite public comment, which would help banks better understand and prepare for regulatory expectations. And Mike, this has always been an issue. We've spoken about it ad nauseum as an industry, that regulation by enforcement is not effective. The industry is looking for a more predictable regulatory environment so that they can comply and operate in ways that, at the end of the day, protect American consumers, investors, bankers. So I can understand why they're looking for transparency and guidance from the Fed.
Yep, certainly as a person who has been registered, I know that dealing with the regulators and not knowing exactly what you're being looked at for is a difficult situation to be in there. Regulation by enforcement is a tough spot, and it's something that I've experienced personally. Certainly. So let's jump on. So the Fed holds rates steady, and Trump didn't seem to disagree this time. Personally, and there's something that you had mentioned earlier is the dollar. Tariffs. One thing going back to the point on tariffs, is tariffs generally would strengthen the U.S. dollar. And, that's an interesting, it's an interesting thing to keep in mind, that the dollar might strengthen, in fact, due to the Trump proposed tariffs. But thus far, we have held steady on rates. Where do you see interest rates going forward with the latest guidance from the Fed?
Well, you know what? I think I'm not sure if there's so much going on over the past 2.5 weeks that Trump is picking and choosing his spots, because the first time around he was strongly advocating for lower interest rates, and we saw the reaction that had to the markets and the influx of liquidity. General consensus seems to be interest rates will be higher for longer. With the economy continuing to move along in a relatively strong fashion, there really is no reason to pull levers and not be in a position to down the road where we can't, because we've seen how that scenario plays out. I think a lot of it's going to be contingent on what the employment picture looks like, right? And again, if you're looking to streamline, a lot of government jobs there that will impact the number somewhere. If tariffs do get passed down to consumers, that will also impact consumer spend, which is a big part of GDP. So again, I just don't think there's enough insight into that yet, because we're not quite sure how it's all going to play out. But if you remove all that, and I think it's important that we make this distinction, regardless of who is in office, Democrat, Republican, Trump, Obama, whatever the case may be, at the end of the day, the market's a market, the economy is the economy. They're two separate things. And I don't think that we should ignore the fact that corporate earnings and underlying fundamentals of companies is what truly moves the needle. And I think we shouldn't lose sight of that and only be focused on the Fed and only be focused on what's happening out of the Trump administration, because you can't ignore fundamentals as well. And we're seeing that happen, in this earnings cycle.
Absolutely. I mean, great points, Jill. Well, listen, thank you so much.
You're
Excellent
welcome.
insights as always, Jill. And until next time,
all right.
See you soon.
See you guys. Take care.
Bye, Jill. All right, let's jump to the charts. We have a couple of things to take a look at today. I'm just going to stop my share for a second. All right, so here is my Dash Trader software. So we're going to have a couple of stocks to take a look at today. So I'm going to bring this to the daily. So first things first, we're going to take a look at the QQQ. So here is the QQQ. This was the big, I'm going to zoom in a little bit. So we had the big gap down on the deep space Trump tariff news, right? So DeepSeek, rather, not deep space. But that was the big gap down on Monday. And then subsequently, we've had 4 days up. Or actually, this was I believe, this was the tariff news. I think this was the DeepSeek news. That was last Monday. And then this was the tariff news. But certainly, this is Google. Okay, so let's take a look at Google. So Google is the one stock that didn't do very well in earnings. Big gap down. It does kind of look like the uptrend is broken on Google. We have gapped below the moving averages, and potentially we're going to get a further sell-off. As it's now below the moving averages. You might get a snap back to the moving averages. And you'd look for a sell setup like pattern, as Google rises back towards its moving averages. And then, of course, you'd want to take a look. But the trend certainly does look interrupted on Google. Now, on Apple, AAPL, we also have this same kind of a look. Apple, gapped up on earnings, completely faded the gap. And then subsequently, it kind of looks like the chart is broken on Apple. So now you got two of the big seven, NVDA, right? We know NVIDIA already sold off. That was on the DeepSeek Chinese AI model, gap down. It's now below its moving averages as well. Now, there is a strong possibility that NVIDIA could fill this gap from 128 all the way up to 142, which would be the gap fill. And then, of course, maybe even retest highs because the earnings are coming out on the 26th. That's 20 days away on NVIDIA. Now, this has been a top mover for some time. TSLA. Tesla, looking still like a big bull flag, but it also could be in that kind of starting of a downtrend pattern, giving up the gains that it made back in November with the Trump election. So now this is the bounce or break point on Tesla. So certainly, again, this is Tesla. I'm not sure why it's. There you go. Hold on one second. I'm just going to go there. I'll bring up Tesla. There you go. I'm just going to drag this down because it was showing Google. I want to make sure that everybody knows that we're showing Tesla. So this is Tesla, MSFT. I'm going to pull out a little bit here. This is a sideways range. So now of the Magnificent Seven, I'm just going to go down the list. We have Apple below its moving averages, Google below its moving averages, Tesla below the moving averages, NVIDIA, we'll see how it deals with earnings. Microsoft below its moving averages. So now we got so far Apple, Tesla, Google, Microsoft, right? 4 of the 5 that I've gone through so far. Now let's take a look. NFLX, Netflix just off to the races, up and away. I mean, almost indomitable. But needless to say, Netflix is the exception. It is still in a firm uptrend, bullish beyond bullish. That's Netflix. And then I'm trying to remember which one is the last of my Magnificent Seven. I have Microsoft, Apple, Tesla, Google. Oh, Meta. Meta also at the top of its range, up and away as far as Meta goes. So 2 of the Magnificent Seven are still in uptrends, whereas 4 of the Magnificent Seven are all below their moving averages. And of course, why is that important? They make up a tremendous amount of the S&P 500, S&P 100, and the Nasdaq 100's overall composition. So as these are all a very big percentage of the overall markets, having 4 of these stocks clearly in almost starting downtrends or breaking down from sideways trends, and 2 of them being in clear uptrends is taking the market into a slightly more bearish direction. Now, obviously, there's still a lot of things going on with the Trump administration, so it's still too soon to say. Now, one other thing I just want to point out is that gold has broken out, and I've been a big gold bull for a long time. Gold has broken out to all-time highs. This is, I believe, gold is at 2,800 an ounce at this point. Silver SLV also near the high of its range, although not quite as bullish as gold. And then GBTC, we're getting a bit of a pullback on Bitcoin and cryptocurrencies in general, but we'll see how that kind of plays out as well. GBTC, again, for those of you who don't know, is the ETF for trading cryptocurrencies. I'm going to go back to my main share. All right. So on that note, stay up to date with all things DAS by signing up for our monthly newsletter and emails. Fill out the form at the bottom of the website at www.dastrader.com. Subscribe to the YouTube channel, Dash Trader TV, and the DAS Newsroom reminders Follow us on social media. We are on LinkedIn, Twitter, Facebook, and Instagram. Trade well, everybody, and let's see how this earnings season plays out. Till next time, trade well.